As has been already said, the COVID-19 pandemic started the worst world economic crisis since Second World War. For the first time after the Great Depression of the last century, both advanced economies and emerging and developing economies are at the same time in recession. Preliminary GDP estimates for the main countries for the second quarter of this year show double-digit negative signs for the largest European countries and the euro area, as well as a slightly less dramatic minus 9.5% for the American economy. In all cases, however, these are unprecedented data and are added to the already heavily negative numbers recorded in the first quarter of the year. Compared to the end of 2019, last year, the data show cumulative losses of around 10% in the United States and an average of around 15% for European countries. So the US economy has so far contracted less than the European ones. Within the Eurozone, Germany is the least affected country, minus 12%, and Spain the most affected, almost 23% of GDP decline, with Italy and France suffering GDP decreases between 17 and 18%. If the forecasts of the analysts are confirmed, the greatest decline in GDP will be recorded in the United Kingdom. On the other hand, in the second quarter. On the other hand, the second quarter data shows that China, the economy most affected in the first quarter, has fully recovered the loss thanks to the rapid recovery experienced in the April-June period. The forecast for the third quarter indicate an expected rebound of the main economies, in particular China, followed by United States, and to a lesser extent by Europe. However, there is a prevailing opinion that the recessive impact of the pandemic has by no means worn off, and the consequences of the crisis will be long-term. The reasons derive from the nature of the crisis we are experiencing and the context in which it takes place. The current crisis originates from an almost simultaneous shock of supply and demand created by a sort of freezing of the economies due to lockdown and social distancing measures adopted all over the world, and which, however, threaten to continue to some extent even after the emergency. It has been crucial, and continue to be crucial, how fast the governments of all the major countries will be able to restore the negative expectations of citizens and companies by announcing and, above all, quickly implementing expansive fiscal and monetary measures. The goal was to find a way to finance immediately the necessary spending on health, and the measures aim to ensure that people are able to meet their needs. Simultaneously, the governments had to support the production system disrupted by compensating the losses of the companies caused by the economic shutdown. We are aware that immediately after, it is necessary to finance a massive recovery plan, that is investments mainly on health and infrastructures. To prevent companies' bankruptcies, many European countries adopted the mechanism of the temporary transfer to the government of the largest part of the wage bill of companies forced to halt their production. These measures, together with the credit guarantees, liquidity facilities, granting of grants had to avoid that firms went out of businesses, creating unemployment that risked to become permanent or long-lasting, because we know from previous crises that the firm-specific skills of workers quickly depreciate. In other words, while the pandemic does not destroy physical capital, it can destroy both human and entrepreneurial capital. Some of these policies have been adopted so far with asymmetric intensity, timing, and efficiency by almost all countries. However, the depth and the long-term consequences of the pandemic depend also on the fact that the countries that have been particularly hit are the countries more integrated in transnational supply chains. That is to say, the countries that depend on intermediate inputs produced around the world, and the countries that are suppliers of commodities and raw material as oil. 7 countries that are or have been at the top of the infection rankings: China, United States, Japan, Germany, France, UK, and Italy, represent almost 60% of the world GDP, 65% of the world manufacturing product, and over 50% of the world manufacturing exports. Each of these countries is an important supplier of industrial inputs to each other and to third countries, and they are at the heart of a myriad of international supply chains. This implies a kind of supply-side contagion via international supply chains that represents one of the greatest uncertainty factors of the global recovery. For this reason, we face tremendous uncertainty on how deep and how long will be the recession, and how big is the risk of a prolonged economic global depression. For the same reason, getting out of the crisis would require the maximum international cooperative game, even if the pandemic has also highlighted the vulnerability of the current hyper-globalization phase and has offered arguments to pre-existing anti-globalization sentiments. Above all, it's important to avoid that the symmetric impact of the health emergency among countries and their different financial strength in supporting their companies is used for a sort of beggared neighbor policy. In other words, for aggressive competitive restructuring of transnational production and commercial chains. Global trade is a complex network of exchanges of intermediate inputs regulated by international, commercial, financial and insurance contracts, in addition to national and international norms. What we need is that the private and financial sectors must find ways to sterilize the current risks deriving from potential temporary interruptions of these numerous interconnections by adopting, perhaps in innovative ways, the necessary adjustment and compensation mechanisms. A private sector response may not necessarily be sufficient on its own and may entail stability risks around the world and for the long term. It would be also risky a reaction by countries that follow the demand to reduce the global interconnections between economies under the psychological pressure of pandemics and in response to political arguments for achieving national self-sufficiency in the provision of essential goods. Restructuring the supply chains in ways that make production costlier would show limited awareness of the interconnections between national economies in the global market. It must not be forgotten that one of the positive effects of an interconnected world is the production of global public goods, like the fight against climate change and pollution, the diffusion of knowledge and education, scientific progress, human rights, the conquest of medicine, and the global fight against endemic illnesses. More attention and concern must be placed in addressing expectations and fears that could determine drastic changes in population sentiment and could condition the strategic investment choices on a global level. International coordination will be also crucial because the potential impact of the crisis on the financial and monetary markets is yet unknown. In fact, the use of financial markets by both sovereign debtors and companies will necessarily be massive and protracted over time. In particular, the government's debts, which are already very high in most countries, risk to grow larger, with foreseeable growing pressure on financial markets, not only to cope with the current phase of economic emergency, but also in the subsequent phase. Sovereign debts are in fact the main instruments that all countries necessarily have to activate to inject resources into the economy and stimulate a productive recovery, going beyond the monetary expansion policies, which have already reached the limits of their effectiveness through mere reduction in interest rates. We remind that even before the COVID-19 pandemic, a great debate took place in Europe on the limits of the monetary policy and on the need of a more expansionary fiscal policy in European countries with fiscal space. However, under the new current conditions, we must ask ourselves whether and to what extent it is possible to avoid a global explosion of public debt. In fact, recourse to debt, including European debt, appears necessary to support monetary policy and inject resources into the economy. But at the same time, its unlimited growth creates the danger of a global collapse of the sovereign bond market and is probably not indefinitely sustainable. This means without limit. The answer can be to channel monetary resources created by central banks toward financing specific pandemic mitigation measures and targeted public investment programs. A monetization of the additional investment expenditure would allow governments to contain the growth of their debts also in the recovery phase. This direct monetary financing of public expenditure can be achieved in different ways. In fact, all major central banks, including the European Central Bank, are already buying massively sovereigns and corporate bonds, even if the European Central Bank purchases of sovereign bonds cannot be considered as monetization of debt or direct financing of government, as in the case of other central banks. These purchases of sovereign bonds by the ECB are not purchases characterized by debt cancellation or by an indefinite renewal commitment at their maturity. And European Central Bank didn't announce what action it will take next, the so-called exit strategy. In other words, these are not transactions equivalent to direct treasury financing to governments by issuing money. However, in the face of the explosion of sovereign debts, the relative benefits and costs of instruments aimed at attenuating or eliminating the ordinary nature of public debt of sovereign bonds should be considered through, for instance, a partial or total elimination of the reversibility of their underwriting by central banks. In the case of ECB, an instrument of this kind could consist in a form of temporary monetization of the so-called golden rule through the purchase of irredeemable public securities issued to cover actual expenditures incurred in implementing public investment programs. Compared to current expenditures, investments have the characteristics of creating real assets as a counterpart, and investment offer guarantees to creditors, since the expected return on investments will make it possible to honor the payment promises. I argued in previous occasion the need to overcome the taboo of monetizing a vast program of European investments in order to finance what was not then allowed by European rules. That is what we used to call now a good debt. The argument was that we were often worried, and rightly so, not to transfer to future generations a financial debt incurred today, if not by creating the conditions for that debt to be repaid. But we were not concerned that the alternative to creation of debt for a good and correct use risked being the progressive impoverishment of human and social capital, as well as the deterioration and the progressive reduction of the stock of infrastructures essential for production and for society as a whole. The damage for future generations, and in general for those who are young today, would be no less than that caused by the financial burden of the debt. Today, it is more necessary than ever, therefore, not to be afraid of a good debt. Even if the effects of the pandemic and the uncertainties we face impose on the governments, whatever it is, this government, great discipline and as well as great determination. I think this is the rationale of the next generation EU plan. However, in this context, coordination between monetary and fiscal policy requires also international coordination of monetary policy between central banks to stabilize international financial markets and to ensure liquidity for economies and governments worldwide. The recent announcement made by Jerome Powell, chair of the Federal Reserve, to the other central bank governors, the announcement that the United States monetary policy will change, will have consequences. The Fed has stated that the employment goal will prevail over the inflation control goal. It was not just a matter of acknowledging that inflation is no longer dependent on the natural unemployment rate of the individual country, and that therefore the monetary expansion policy will not stop in the face of a reabsorption of current American unemployment, as it happened in the past. By stating that the policy of low rates and liquidity expansion will continue for a long time, even if the inflation rate were to exceed the 2% threshold. In this way, the Fed announces that it will go its way by looking only to the pursuit of maximum employment. This confirms that we are entering unknown territory, not only because we don't know how we will be able to return from ultra-expansionary monetary policies around the world, but because we are moving away from the idea that international coordination of macroeconomic policies, monetary in the first place, is necessary to exit the crisis caused by the pandemic. On the contrary, each large country will go on its own, looking internally and without considering the external repercussions on foreign exchange. We don't know what the consultations between European Central Bank and the Federal Reserve are today on how to maintain relative exchange rate stability. But if there is a divergence between monetary policies, the problem will arise. Therefore, the problem posed by a long tradition of economic theory become again topical in this moment. That is, it is difficult to avoid global imbalances if a national currency, like the dollar, is used as an international currency that reflects the internal political needs of the issuing country, especially if there is no explicit or implicit international coordination. I want to conclude just saying that I think that we have to look at the pre-COVID existing three global trends. The retreat from hyperglobalization, the relationship between market and government with the growing role of the latter, evident also in Europe, and a falling growth rate. Regarding these three trends, the COVID-19 probably will not be a game-changing event, but probably a game-accelerating event.
Professor Fraud, what do you take away from Mr. Tria's speech?
So there's a lot to discuss in this speech, and what I wanted to do is highlight some important themes that came through the speech in different places. And I think these themes struck me. They're all very important, and they're all often described as trade-offs. Now, in some cases, we might want to debate whether there is a real trade-off or whether it's simply an apparent or a convenient trade-off. And I think these themes are important because they highlight some key choices that need to be made and managed as part of what we could think of broadly as economic management. And they're also, I think, echoing the theme at the end of the speech. These are also not new things. So many of the things we have to deal with are not new things, as Giovanni Tria emphasized. They're old big questions, and they're questions that we need to focus on. So there are five themes I'll just list as these kind of trade-offs or pseudo trade-offs perhaps that we need to think about. The first one is this trade-off between opening up economies and protecting vulnerable citizens. Clearly there's the very stark figures on the decline in GDP show the great costs of the pandemic on our economies, but we have to be cautious about the sense that it's the economy versus citizens and vulnerable citizens. The second theme is one around global cooperation versus nationalism, and this is something that we're seeing a lot of, particularly around the issues of supply chains. And I imagine that when we have vaccination looks like something that may be more tangible, then I suspect this debate about globalism versus nationalism is likely to become even more exaggerated. Third theme, this is about the idea of supporting economies and supporting traditional objectives around growth versus dealing with nature and climate emergencies. And so clearly this is something that we've been struggling with before the crisis. It's something that becomes more intense, and it's an important theme that we need to have to consider. Again, like my first one, is it the economy versus citizens, or is there no trade-off here at all? Is it really, in the long run, these things are important and aligned? The fourth one is the idea of the importance of economic stimulus now to address crises around employment, but also crises around deterioration in public services and the need for wholesale investment versus the risk of instability, market instability, further down the line. And again, this is the trade-off that's being posed, and we need to think about to what extent there is a trade-off and what the nature of that trade-off is. And then the fifth one, again, a very important one that was highlighted in the speech, this kind of very traditional sense that, you know, economic management comprised either focusing on managing inflation or managing employment, or we can flip that around and say managing unemployment. So again, this is a key debate around economic management that needs to be thought about and was raised very, very nicely in the speech. So I think I really welcome this speech because it sort of put all of these different things, you know, on the table for us to think about and raise a lot of important questions, particularly these last two in terms of the macroeconomic management. So having outlined what I thought were five very interesting areas where we could debate to what extent we have trade-offs or alignments, I wanted to raise two questions. The first one is, how do we persuade not only politicians but also citizens about the need for a more imaginative way of thinking about economic management? You know, we hear very often these characterizations of economies as being like households, particularly in relation to debt. So how do we get round this idea that, you know, good economic management should be avoiding debt, should be trying to be, you know, prudent, responsible? You know, it's a very limiting metaphor to view the economy as if it were a household. So how do we make that politically but also electorally popular? Many citizens may be concerned about, you know, the increasing amounts of debt that are likely to arise from economic management in the next few years. And my second question is, on the basis that large amounts of debt are likely to be essential in order to support investment in public and social services, as well as, you know, the extent to which we want to support private entities, how do we make sure that we invest in the right things? So how do we know what we want to invest in? How do we have that debate about what's the right thing? So for example, there's a lot of discussion about investing in green jobs and green technologies, but there are clearly choices here, and there are questions about how do we know what's the right thing to invest in? And if we think back to our last financial crisis, the banking crisis from 2008, we invested a lot in supporting our banks, and arguably we got very limited benefits back from the banks in due course. So how do we ensure that, you know, the investment that's being made in not only in public services but also inevitably in private companies is going to be, you know, is going to be repaid to society as a whole? So I'll stop there. Thank you.
Professor Tria, how would you handle these 5 trade-offs?
Implies a lot of time to discuss, but I try to just catch some main problems. For example, one of the first question was how to change the management of macroeconomics, the quality of investments, how to use investments for a green change or new technology, etc., etc. Then other kind of question was the rule of law. It implies a discussion about, I think, the governance of EU in general, the approach, etc. And then the last questions. I try to start maybe from one of the last questions, and then I come back. I mean, about the problem of the sustainability, which is my view. My view is that we really entered in unknown territory, and we have to discuss about that. Of course, some unknown territory was present in some way also before the COVID-19. If we start what we were discussing last year, we had a huge amount of liquidity around the world, but no investment. No private investment, no public investments, with a huge amount of investment in infrastructure needed at the world level, in developing level, countries, emerging, and Europe, and the United States also. What's happening? What was happening? Now the problem is worse because we have a big increase in debt, in some sense in liquidity, but till now we don't know if we'll have some investments, because it's true that the recovery plan is just a small part, even if this plan will start, will be implemented in the right way and in the right time. But it's a small part of the problem of how to increase the rate of growth. And this depends also on how to increase investments. My idea is that we have some progress, for example, in Europe, because we stopped these mainstream ideas that we can't invest more, we use debt for public investment. But for example, why don't have a private we didn't have a private investment, even if we had a real expansionary monetary policy with a negative or a very low rate of interest. One of the problems was that in a globalized world, the old idea, the Schumpeterian idea of the destruction and construction creates some problems also in the past. But now the problem is where we disrupt and where we will build up something something new. And when we disrupt and when we can build something new. And this is the problem of transition. I think that you raise a problem of transition. And the political economy is how to manage the transition. Then I think that we need really a new macroeconomic management in Europe and also macroeconomic cooperation at international level, because we don't know what will happen if we can have a new financial crisis or not. What's happened in Europe? EU recovery, the change, the European debt. I think that European debt is debt. I don't think this is a problem to have an Eurobond or national bond, because it's debt. The problem is how we can use this debt. The problem of the proposal of the Spain proposal of the eternal to issue eternal bonds depends who is ready to buy these eternal bonds. The eternal bonds at European level can work if the ECB purchases these bonds. This is monetization. We have to solve this problem, how to manage. What's happened? I think how I interpreted this change in Europe. Of course, this change came from an agreement between Germany and France. The country that changed its mind was Germany. But why Germany changed? Of course, because the international context changed. I think, my interpretation, that Germany understood that it was not possible to go on with his model of growth. I mean, a surplus of 9%, because the international context changed. The globalization was, and the need to have a more strong internal market, a European market, but how to rebuild some supply chains more regional, more in Europe. This has changed. Then in this way, Italy cannot fail. Other countries cannot fail. But the problem is how to rebuild the industrial policy in Europe. This is one of the answers. How we use the debt, not just to sustain unemployment, but how to face the transition. This means that during the period in which we build a new industrial chain, rebuild a digital economy, etc., how we manage the transition, the social transition. Because we don't change, we don't have a digital economy, green economy in 1 year. And at the same time, if during this period we have bankruptcies, a large amount of bankruptcies, we have to face, of course, the problem. Last year we were discussing about how to change how to build European industrial policy. This was the matter, but it was impossible. It was impossible because the northern European countries were and are sovereignist. They don't want to go on for an European integration. I remember that in a speech, I think in Paris, with the French people, I said that my impression that in Europe, we were spending all our times to discuss how to be together. But we didn't discuss why we should be together. We should be together is to have European macroeconomic policies, European policies. This is the change that we need, for example. This is not an answer about the sustainability in the long term of the debt, but this is one of the answer. Of course, if we increase the debt, it's not sure that the result is to have a real European policies. And then enter in the last questions, and the geopolitical, 1 minute, okay. In a geopolitical discussion. For the geopolitical discussion, I used to say that when we discuss between United States, Europe, China, etc., we don't forgot that if we put together the population of the United States, Europe, China, Russia, this population is less than half of the world population. This is one of the other problems in the future. I think nobody is discussing about that, how to have a coordination. But what I was saying about the European policy, yes, I remember, for example, that once I discussed with the economic research studies and so on in Europe about its report. I read an European report, the report that usually they prepare each semester, etc., in which we could read an analysis of the economy of each countries without an analysis of European economy as a whole and what the European economy as a whole needed as a macroeconomic policy.
Thank you, Mr. Tria and Fraud. What we get from this session is that we should channel monetary resources created by central banks into financing specific pandemic mitigation measures and targeted public investment programs. Today, it's not time to be afraid of good debt if governments will have great determination and diligence. This is the rationale of the Next Generation EU program. In the case of the ECB, an instrument could be a form of temporary monetization of the Golden Rule through the purchase of irredeemable public securities issued to cover the actual expenditure incurred in implementing public investment programs. We must promote multilateralism and international cooperation with the aim of creating sound macroeconomic policies for a more effective recovery strategy.